Happy July 13th, Kirk Spano, investing 2020s, and inflation continues to go down. A moment ago, we were listening to an interview with Luke Grumman and Grant's Interest Rate Observer, where Grumman said, "Why would we ever own bonds?" Let's talk about that in the context of all sorts of things that would make that statement true. As you have come to know over the years, I have not been much of a bond guy. I have only bought bonds on big displacements. If I could buy $100 bond for a 20 or 30 or 40 or 50 or 70% discount, then maybe I would do it. Because in general, the coupons on bonds for 20 years now, for 15 years for sure, since just after the financial crisis, haven't really been worth owning because the dividend that you could get on most stocks was better. And the risk profile between the stocks and the bonds wasn't really that much different. Now, that's not the way it's supposed to be, but since the financial crisis, that's the way it's been. Will that change? I think for a little while, bonds offer an opportunity on the short end of the curve, those 2 to 5 year US Treasuries, because we know that interest rates on the short end of the curve have to come down, and I will prove that to you today. However, the long end of the curve, people ask me about the 20-year Treasury and TLT, and my response is pretty simple. Those interest rates are relatively range bound, in the fours for the most part, every now and then sniffing above 5 or sniffing below 3, but really in the fours. So there's not a lot of movement there in an era where yield control, which the Japanese did for a generation, is becoming more and more normal. The Federal Reserve has a lot of reasons to control the yield curve. The US Treasury has a lot of reasons why they want the yield curve controlled. And so you're probably going to see that, because once people start to wrap their head around, and this is a story that's been going on for 30 years, and people still don't want to figure it out. The reality is that the demographics of society, not just in the United States, but globally, are driving a wave of deflation that started 16 years, 17 years ago, that is being met by policy that is inflationary. So that is, deflationary demographic trends in the economy are being met by inflationary policy, both fiscal and monetary. And if you don't accept that, you need to, because you're wrong. The economy is in a deflationary period that began right before the financial crisis, was exasperated at that point because of all the cheap money leverage, because Alan Greenspan, frankly, was an imbecile as a Fed chairman. So as aging demographics drive more dependency, called the dependency ratio, on government for healthcare and welfare, expenses necessarily go up. And you can try to have austerity. You can try to cut entitlements. You can try to cut welfare programs and healthcare programs. But the problems that you create are even bigger than the ones that you prevent, which is, oh my God, debt is high, I want to cut the debt. Well, the problem with cutting the debt, and the deficit in particular, deficit being this year, is that you drive standards of living down and you drive economic activity down, which means that you shrink the economy, and that's bad. As you saw with Greece a few years back, that were trying to get out of their debt problem through austerity, you had civil unrest, you had mass poverty, and you essentially had the collapse of that economy, a collapse on top of a collapse. It was a death spiral that required massive bailouts. Otherwise, you would have had probably war, because that austerity spread to the neighboring countries. In a world which is economically interconnected, a big problem, even in a small place, has rattle-on effects. Imagine if the United States decided, hey, austerity works so poorly for Greece, we're going to do it anyway because we're better, America first. Imagine if we did austerity. What would really happen? One of the presidential candidates' platform is to dramatically cut government spending. What's going to happen if we do that? The economy will shrink. People will get angry that they lose their food stamps or their Medicaid or their housing subsidy or whatever it is that they're getting, and crime goes up. Interestingly, for the last 3 years, crime has gone down. Why? Because we haven't cut those programs. We've been in a period where we needed more labor and people moved into the labor force. Labor participation is back up. So I think that we really need to think through. We do decide to have a shock to the system. I was watching one of the Batman movies with the Joker and the scene where people try to ask why the Joker is doing what he's doing. I believe they have a big pile of money and he's going to burn it. And his answer is some people just want to see the world burn. I don't know if that's always the case when we burn money. I think a lot of times it's because if we burn this pile of money, somebody else can steal from that pile of money. There were some interesting conversations on Bloomberg this week in which a couple of the short sellers were talking about how this is the age of theft. You've heard me talk about how corporate executives are pilfering all sorts of public companies and getting away with it because we have twice this century cut the enforcement powers and the manpower of all the regulators, leaving most of them short-staffed and without experience. Supreme Court just neutered the regulators a bit more. So I think you really ought to ask yourself, how many of the companies out there should I be invested in? I think the answer is pretty clear. You need to have corporate executives that are very aligned to you, that aren't just sucking money out of the corporations, asking for 12% of the company as compensation, for example, Tesla, and they can drive growth in a world that has overriding deflationary forces, which are anti-growth. You need to make your money where there is growth. People are going to tell you back, but I like the big fat dividend. And I can show you in chart after chart after chart that all those dividend chasers, when you take a look at their total return, oh, I have a 9% dividend. Yeah, but the stock is down 5%. You only made 4%. You could have done that in the US Treasury. And when the inevitable recession comes, whether that's next year, the year after, or in 5 years, those stocks will lose 50, 60, 70, 80, 90%, and some will go bankrupt because they don't have the growth underlying to support those dividends. So what should you be doing? I'm going to tell you this again. You need to invest in growth. And if you want income, you had better learn how to be an option seller, because selling options just twice a year on any particular growth stock will generally give you an income, a dividend equivalent income of around 10% or higher. And it will cut your equity risk to the point where it's not much different than bond risk, because bonds without growth deteriorate in value because of the inflationary policy. So think through the deflationary natural economic forces, aging demographics, versus the inflationary policies of government and central banks. And they struggle to find balance. And the narratives that are out there are driven by, frankly, not particularly educated people in some cases, or people that have ideology above empirical data. And in many cases, people will throw up a chart, take it out of context, not give the supporting information, sort of like throwing something up and you see a whole page of footnotes and nobody reads the footnotes. There's an entire service out there, I forget what it's called now, about the footnotes in corporate document. They give you this pretty picture and then footnote. By the way, we had this bad thing happen and we're covering it up by calling it a one-time item. But we've had similar one-time items every single year for 13 years, 14 years, 15 years. Kind of makes you think that it's not a one-time item. They just don't want to tell you that it happens over and over and over again, because that'd make their numbers look bad, which means that the corporate executives wouldn't get their bonuses and their options. And have you noticed how corporate executives recycle every 5 to 10 years? They go to a company, they work there 5 to 10 years, they make a whole bunch of money, company has a correction, they get fired or they quit. They sit on the sidelines for a year or two, they enjoy the money, they let their resume marinate, and then somebody says, oh, I need a CEO for this, that, or the other thing. They go, oh yeah, talk to the headhunter, maybe I'll be interested. And they get the next big offer, because time erodes people's memory. The millennials have no concept of what the financial crisis was. They've looked at a couple of YouTube videos. They've listened to Joe Rogan, who doesn't know shit from Shinola. They say, oh, we just need to cut the budget because then everything will be fixed. Greece. You can look historically to every single austerity that was out there, and virtually all of them failed. Most of them led to a deep recession, not just a little recession, but a deep recession. And quite a few of them led to depressions. So when the populist rhetoric is trumping along, saying we need to cut the budget, ask yourself a question. Do you want your Medicare cut? Do you want your Social Security cut? Do you want to pay more tolls? Do you want Europe invaded by Russia? Do you want Taiwan invaded by China? Right? Start asking yourself some hard questions about what you want for you and what you want for the world, and understand that bad things that happen in the world necessarily reverberate. We're pretty insulated by the oceans, but we're not that insulated. So we see that inflation cooled down in June, but just how much did it cool down? Oh my God, it's still 3%. That's too high. But is it? As you can see, natural gas prices went up, which is a big one. But one of the biggest items out there is rent. And rent, which was much higher before, is starting to come down pretty rapidly. Car insurance has gone up. Why? A wave of thefts, a wave of reckless driving by younger people, which I think is a product of a lot of the licensing policies around the country coming out of COVID, where people didn't have to take classes and tests. We'll see. But this one coming down is a big deal. Energy going up, that's a negative. It's one of those things where when you hear the industry, the oil and gas industry, say, oh, Biden is slowing down LNG export facilities, maybe that's a good thing. Remember, LNG exports are going to double in the next 3 years because of all the projects that are already being built. They're complaining about not being able to build even more projects beyond that. Do you really want more of our natural gas exported? It's a pretty good question, I think. But the oil and gas companies want to make more money. Yeah, but do you want to pay more for your natural gas? You're already seeing it. You're already seeing it. It's why we bought Terra. It's why we own Occidental. It's one of the reasons that we own Permian Resources, New Fortress Energy. I don't just willy-nilly pick out companies. There's a macro reason behind almost everything that I do. Or an M&A reason, or a growth reason. There's reason. I don't just say, oh, look, a 5% dividend. Yay! Gotta love it. No, not if that dividend's going to go away someday and the share price is going to collapse right along with it, or vice versa. So inflation's coming down. Again, how much is inflation coming down? On a month-over-month basis, we had no inflation last month. When I first told you that a couple weeks ago that the number was going to come in at 0, I didn't know it'd actually be negative. What is negative inflation called? Somebody type the word in. You've heard it today already. What is negative inflation called? Deflation. That's right. Put in the D. Somebody just put in D. That's right. The natural pressures on the economy are deflationary due to aging demographics. 3.5 million baby boomers a year, give or take, retiring through the end of the decade every year. How do you replace 3.5 million people in the workforce when the birth rate is only half of that and has been for a generation? If twice as many people are retiring as are coming into the naturally born population, how do you fix it? Let's just take an aside here. One of the inflationary forces out there is that wages in the past year or so, year and a half, have been going up more than inflation. And this is what you want. These have to do with COVID. And I would point out that this number was coming down as this number was going up at the end of 2019. And I've talked about that time period over and over again. We were starting to get stagflation, which I forecast in 2017, in 2019. And then COVID blew the whole thing up. That was heading down. That was heading up. This is before COVID. These lines were going to cross in 2020. Now, people can say, well, you don't know that. And you're right. I don't know that because I don't have a time machine. Sure would love one. Just like to be able to look through the window of time, an alternative reality, the metaverse. Would that be cool? But we know what the trends were. Wages were starting to fall at the end of 2019, or actually through 2019, and inflation was going up. And right here is when they did the quantitative easing that they didn't call quantitative easing because the repo market was failing. Go on Reddit, you can find all kinds of old threads, or just do a Google search, 2019 repo market. You get 1,000 articles. So coming out of COVID, we had the surge in inflation, and then we did have a surge in compensation as well. And now, because of the Fed tightening things up just a little bit, really just the normal, to historically normal, the Fed tightened, which really isn't tight. It's historically normal where we're at right now. From a monetary standpoint, wages are higher. Now, I don't know if we get a surge here. I doubt it. Depending on what we do with immigration, this should start to chop sideways. And there should be a gap that develops between inflation, which should head down into the ones again, and compensation staying up at a 3 or 4% per year increase. That would be really good. Will it happen? Hard to know. There are some cracks. So this is what the the employment numbers have looked like. Had the really down April. And what we want to do is we want to be around 200,000 every month for new jobs. And we want the adjustments in general to be positive. So the dashed line, which I'm sure is hard to see, is your preliminary number, then your adjustment. And we'll see what the adjustment is for June. But we need this line to stay right about where it is. Now, one of the things that helped inflation go away was that we allowed a lot more people into the country for a couple of years. This is a chart going back 30 years. You can see that immigration was choppy, but in a range for 30 years. Dropped a little bit because of COVID, and then it jumped back up. And what we find is that a number of immigrants per year, around 3 million, tends to be about the right number. And that jives with me saying that we need about 30 million more people in the country over the next decade. So why did it jump up to 4.7 million? Because a lot of people came to the border. And you can see the orange line is people coming from Latin America. And that is partially climate driven. Somebody wants to say Biden. Well, no, he didn't invite the people here. He didn't send a plane for them. The border wasn't any less secure than it was under Trump or Obama or Bush. It's the same border with a little bit more fencing and a little bit more patrol. It was just that many more people were like, things are screwed up in Central and South America. We're going up to the United States. That is probably going to be something that we have to deal with for a very long time because we are still stupid when it comes to fighting climate change. We're slow, and until there's a catastrophe, right, like Miami falling into the Atlantic, until something like that happens, where a major U.S. city gets wiped out and a voting bloc goes, oh my God, we have to fix this, we're not going to be smart about it. I suspect that event is coming sooner than later, but we'll see. But we do know, going all the way back to the 2002 quadrennial report from the Pentagon to President Bush, that they have cited climate change immigration, right, climate refugees, as a top 5 threat. This is not brand new. The Pentagon has been talking about it since the early 2000s. It is one of those multivariate things that you have to consider when you invest. And the idea that there's really much that we can do to other countries to keep them from allowing immigration is a weak argument because they don't have the manpower to do it. So while we can vary what we give other countries, what are you going to tell some of these countries like Colombia and Ecuador and El Salvador and Nicaragua and Guatemala? Hey, keep your people in your country. We'll give you more money. Yeah, not every government out there is terribly responsive. A lot of them steal the money. And they really don't have a national guard like we have to secure the border. I mean, I'm not really against securing the border. I'm not. I think there's smarter ways to do it, and I think there's smart ways to do immigration policy. I think the bipartisan bill that was passed a while back and then stymied was a pretty good one. It was a step in the right direction. One of the things we know is that we need quite a few people for agriculture. Between 500,000 and 1 million people for agriculture every year that we don't have. So let's say it's 500,000, and those are temporary workers that really, in most cases, become permanent, even though they get a couple months off. But the whole back and forth idea, it's never proven to be true. Most people who come, and they stay. So far, the problem that we were going to have with the workforce has largely been rectified, but then it's still kinks. As we get closer to 2029, you see how it bends over again. And these are just projections. But in order to keep the economy growing, we do need a certain level of immigration. And it does appear that the number is around 3 million a year. So 4.7 million is too high, but it made up for this and at least gave us some leeway. So I'd say 20 to 30 years from now, the United States is probably at 400 million people. And because the millennials will eventually retire, right, we're going to get a window, which I'll talk about in a second. We're going to get a window where expenditures on the boomer retirement should flatten and then fall. And then my generation, as we retire, we won't be that strenuous on the government because we're small. But then the millennials retire, starting in about 20 some years, 25 years and really hitting it in 30 years. So this is something that has to be managed over time. And this is where you manage probably a number around 3 million. One of the things that can happen is, and you hear me talk about positive and negative surprises. The Bloomberg U.S. Economic Surprise Index at its lowest point since 2019, meaning that there's more risks to downside surprises or more likelihood of downside surprises than upside surprises. So we need this to reverse. What can reverse it? Well, we know the federal government spending has kind of been a leading indicator. So federal government outlays lately have been up, so you'd expect this to turn up shortly. But as you can see, government outlays are flattening by design. I mean, they are trying to do that. How do we keep government outlays high and still be able to afford it? Think that through. There's a way. What do these look like? What is that? What's your favorite animal? Whose jaws are these? Alligator jaws, right? And they necessarily will close. So the leading economic indicators are probably going to turn up, which is what I just said here. And the thing that will happen here is that interest rates probably have to come down. 10-year yield, yes, but really the 2 and 5-year yield. What the Federal Reserve really controls, which is the short end of the curve, right? The Federal Reserve doesn't have a lot of control of the long end. The long end is really an expectation by bond investors that they get something for lending their money for that long, and they have an idea of what they think the economy will do over the long term. Here's your debt. Just gone crazy since the financial crisis. GDP has grown a bit, kind of brought it back down off that spike. And what we need to see happen is for this to chop down back to this level at least, hopefully by the middle of next decade. And we can do that by flattening expenditures without decreasing them, or just letting them rise 2 or 3% per year because there's an offset or two. What can the offsets be? Well, there's a couple offsets that could happen. Lower interest rates. If we have a deficit each year of approaching $2 trillion, how do you reduce your interest expense? Lower the interest rate. Issue a lot more 2 and 5-year bonds in the short term, which is what Janet Yellen is doing, on the anticipation that in the next 2 to 5 years, interest rates dramatically fall, which I believe they will. So if interest rates dramatically fall on the short end, say get down to 2% at the Fed funds rate or lower, I think it'll happen in steps. I think it'll be a little bit soon, and then a flat period, and then a plunge towards the end of the decade. We might even get 0% interest rates at the Fed funds level when we finally have that boomer aha moment. Wow, is this going to be expensive for a while? At that point, the 10-year Treasury, where we have that chart, at that point, the 10-year Treasury and the 20-year Treasury maybe comes back down in here, 3.5%. And then you issue a whole bunch of long-end debt at 3.5%, or at least below 4%, and you buy yourself a generation at low interest rates. And then what happens as the baby boomers get older? I know this is a little bit morbid, but what happens as you get older? More likely to die, right? I have my 95-year-old, my second 95-year-old grandmother, right? The 94-year-old died last year and a half. And I've got a 95-year-old grandmother left, and she's on home hospice. People die. The average baby boomer right now is 76 years old, 75 years old, something like that. The oldest ones are 78, 79, right? This is 2024. Baby boom started in 46. So 78, 79 years old for the oldest baby boomers. What's the average life expectancy? About 10 years, give or take, depending on health. The last baby boomer gets on Medicare in 2029. And by then, the average age, or the oldest boomers, I should say, it'll be 83, right? You get older, you get closer to death. Sometime during the 2030s, the boomer generation will shrink, and the lines that you want to see cross, right? The millennials are already a bigger generation than the boomers. That line crossed already. As the boomer generation becomes smaller than the X generation, me, government expenditures come down. That's going to happen somewhere in the middle 2030s, 2035, 6, 7, right in there. So we have a window that we have to get through between now and then, the next decade or so, where we have to find a way to finance the deficits. Well, we can reduce the deficit with lower interest rates, number one. How do we get the lower interest rates? The Federal Reserve. Who's going to buy the bonds? As you see here, Treasury market liquidity has gotten very, very tight. It's not very good right now. Why is that? What big player has been buying fewer bonds? The banks. Why are the banks buying fewer bonds? They're kind of screwed on commercial real estate. So if foreign bond buying is down because China's not really buying our bonds anymore, and I will tell you, I think Japan's going to buy more because of the nature of their deflationary environment. They need to tie themselves to us. That'll be, an offset. Hedge funds have been buying bonds using leverage, and they're going to make a lot of money here as interest rates come down, but they're probably not going to reinvest. So who's going to have to reinvest money into US treasuries for the next decade or so? It's going to have to be the banks. Can you see a quid pro quo coming to help these banks with the commercial real estate? I've been talking about this since last year, right? When SVB and First Republic, when they went under, I talked to you about how there's going to be consolidation in the regional banking sector to create bigger banks that participate more in the US Treasury market in return for helping those banks out. And the quid pro quo is buy US Treasuries because we're going to call that risk free. Argue that all you want. Put those on your balance sheet. You can turn them into cash at the window anytime you want if you need it, and we'll help you work through this commercial real estate problem using those US Treasuries that you buy, and then you borrow the cash out, right? So that's coming. And think this through. If the Fed lowers interest rates and we get a recession, which we will in time, I think we have the skip straight recessions in the short term. But I think by the end of the decade, we got a pretty doozy going. I don't know that there's a way around it. And the government likes a crisis because then they can just pump all kinds of stimulus into the system and buy themselves another 10 to 20 years, although they've only been buying 5-year increments. The next time they do this, they have to buy a decade. If they buy a decade of time with low interest rates, then everything probably smooths out over the next 30, 40 years. As an investor, your game is shorter. You're not thinking 30, 40 years out. You're thinking 5 and 10 years out. If you watch Wall Street Week this week, one of the investors talks about, Sam Zell's company, the people who took over CBI, is it called? I forget what Sam Zell's company was called. They talk about we invest today, and then if we see something changing about 5 years out, we exit. They give themselves some time to play the cycle and get a price. So if the government is going to have to keep expenditures where they are, and a little bit higher each year, 2 or 3% higher each year, which they need to do. Otherwise, you cause a deep recession or a depression, and people get angry and bad things happen. And the Fed's going to lower interest rates to help out. The Treasury is going to cut a deal with banks to bail them out on the commercial real estate, get them to buy U.S. Treasuries in return. Japan's going to need us. Europe's going to need us. A lot of emerging markets need us. And ultimately, I think China comes back. That might take a long time, a generation potential. Ultimately, the United States is in a pretty good position demographically compared to Japan, China, and Europe, and even some of the emerging markets. Youth and education equal economic growth. That is the formula. Youth and education equals economic growth. And that's what we look for around the world. It's one of the reasons why in the last several months I've talked about investing in Latin America. Young, getting educated, and they have resources. The United States is the world's capital market. I don't really see that changing in the next generation or two. If you ever get within 5 or 10 years of it, really? I understand that people pound their table. Oh, it's a dying empire, and there's this fetish with the Roman Empire right now. Economics are relative. Investing is relative. It doesn't matter if the economy isn't as great as it was in the 50s. What matters is, are we getting better faster than others, even if the absolute rate is lower than it was in the past? I think the answer is pretty clearly yes in most cases. Compared to the other big economies, the United States is seeing better results than Japan, China, and Europe. And that is unlikely to change in the next generation. And you have to go selectively country to country, but who cares about the little ones? Seriously, they don't affect us that much. We can pick and choose who we work with. Canada and Mexico for sure. Central America and South America, yes, they're in our hemisphere and there's security concern there. Southeast Asia to help keep China contained. But really, ultimately, we want China to do well because that's good for peace. Eventually, we want Russia to do well because that'll be good for peace if they can ever get over their paranoia. Really, the odds of us ever invading them was as close to zero as you can get. And yet, they still base everything on what if the West invade. And the only country that's ever done that is Germany, at least in modern times. And they're not really up for it anymore. Can you imagine the Germans marching into Russia? They'd be marching in there going, hey, can you buy a car? Right? Can we build something for you? not trying to take anything over. So ultimately, again, if we don't blow it all up, things probably work out in the very long term. Can have resources from space eventually. Technology keeps making our resource use more efficient. Dramatic improvements in the last 20 years. 5 years ago, actually 4 years ago, I told you that the cost of batteries would drop at least 50% in the next 5 years. So we're 4 years past CES 2020 when I told you battery costs would come down 50% in 5 years. Anybody know how much they came down in 4 years? About 80%. And we're still using lithium, but we're on the verge of using much less of it. At a time when Exxon says, hey, let's produce lithium, there's going to be a lithium glut at some point. There is right now. And even as EV use does eventually go up, because we have a catastrophe and we're like, oh my God, we better do this, there's really not likely to be any shortage of lithium. It's really not that scarce of a thing. It's just that we haven't built out the infrastructure to get to it. Argentina loaded, right? Argentina is a country that you should be thinking about. They have a pretty bright future if they can find balance, right? They don't go from one extreme to the other. So what's going to happen in a world where the government needs money to pay its bills? We know that they can lower interest rates. Okay, that cuts the interest on the debt. So that shrinks the deficit. But you're still running $1 trillion deficit, according to the CBO, for at least the next decade. What can you do, right? What's the thing that would change that equation? Faster growing economy and higher asset prices. What do we know about tax receipts? Tax receipts go up when what happens? What two things? When the economy grows and asset prices go up. I haven't showed the chart in a while. I'll find it for next week. When the stock market goes up, tax receipts go up. That's why in 1999, we basically had a balanced budget. It wasn't just that Clinton and the Republican Congress flattened spending, right? They got it down to a 2 or 3% per year deficit, but then they had a surge in revenues and tax receipts, but the stock market went up so much. 1999 and 2000, we basically had a balanced budget. Then the stock market came down, right, for 3 years, better part of 3 years. And we've had deficits ever since because we just kept spending our way out of it. Part of that was the anticipation of demographics. But at the time, it was mainly, hey, let's just try to grow. Let's deregulate. Let's cut taxes. Let's do this. Let's do the other thing. And they spent at a time when they cut taxes. And that has generally been the reason that we get deficits, is because we both increase spending and cut taxes. And when the deficit is flat, right, not increasing much year to year, it's because we flatten out the spending a little bit and the stock market's gone up and we got more tax receipts. But under Obama and Biden, we at least haven't cut taxes to exacerbate the problem. Yeah, I think I said that right. So what happens when the market anticipates rate cuts and ultimately quantitative easing, which I think that we get in the next couple of years, and then we get a lot of it towards the end of the decade, whenever the boomer crisis hits. So a little bit of QE in the next couple of years, but a lot of QE by the end of the decade. S&P 500 goes up because that's what people index to when they're employed. So if you keep an eye on the employment numbers, as long as unemployment doesn't get out of hand, people just keep pumping money into their 401k. And most of that is indexed to the S&P 500, whether they use an index fund or not. The 80% of the investors out there have no idea what they're saying. I'm going to put it over there, but spread it around. That's safer. It's not, but whatever. Greatest investors in the world all the time tell you not to spread your money all that thinly. And yet people do it anyway. I heard it's safer. Diversification. Good for me. Yeah, not during a crash. Everything goes. Except there's usually one or two things that don't. So at the start of the year, I said the stock market and the S&P 500. Right? I said the S&P 500 would get to 5720. Everybody laughed at me, and here it is at 5,600. QQQ, I've been telling you for years, is the main thing to invest in, and it's outperformed again. I think it's going to chop for a little while. Hopefully it comes down 5 or 10%. That would be swell. And then the other thing that happens when they cut interest rates, the historical trade has been small caps outperform. Now, industrials will also do better. They've come down last couple of years, but there's been massive spending on industrial build out. So their capacity is higher. Their capex is falling. Interest rates are going to be falling. And ISM, which has been negative for about 6 months, looks like it's turning up. So beating up industrial stocks with growth in the business probably are in really good shape. And by the way, they're starting to use AI to increase their margins. Financials, my feelings on that. Why own a big bank when you can own Microsoft or Apple? And why buy a regional bank that hasn't gone through its collapse period? Buy the regional banks as they collapse, like a week or two later, because when they collapse, they cut a deal. It's usually a good enough deal that things get better. We've basically bottom ticked New York Community Bank Corp, right? We've been buying it in the threes, and it's going to do a 3-for-1, 1-for-3 reverse split. And what did we learn from Spire Global when they did that? Who's able to invest in them when they get the share price back up well above $5 a share? Institutions. They reinvest, right? Because they have stupid rules. So they have to undo the stupid rule impact. Stupid rule being can't invest in something if you're an institution if the share price is under 5. It should be a market cap rule, right? I mean, but whatever. They do the reverse split because they comply with a stupid rule that probably made sense at some point, or maybe it didn't. It might have just always been a bureaucratic thing. But we saw what happened to Spire Global when they did their reverse split. Stock price went on a ramp up. New York Community Bank Corp is going to be the same thing, and they are in tremendous position to be an aggregator, to be a company that absorbs other troubled banks and says, okay, we don't need that 1/3 or half of your branches. Let's get more efficient. Let's hit the online stuff, keep the customers, right? Because customers won't leave just because a branch disappears. They'll just go down the street, but they'll do more online banking, which is already happening. So the short story here is this, and I'm going to play that Grant Williams interview after this. The short story is this. In order for the U.S. government to afford the budget, certain things are going to happen. One, interest rates are going to come down to cut the interest on the debt. That'll shrink the deficit, depending on how low they take interest rates, between 1/3 and 2/3. It's a big number. So if the annual deficit is pushing $2 trillion, which it is, but about half of that is interest. I think it's a little over half interest now. They cut interest rates, they can reduce that. I came up with $600 or $700 billion they can cut with lower interest. And then you need higher tax receipts. And the way that you get there is through quantitative easing to pump money into the system and inflate stock and real estate assets. So that when people sell, the government makes a bunch of money. Interest rates come down, quantitative easing reappears, fiscal spending stays the same, right? We know that most of the fiscal programs out there run through 2032 right now for the spending, from the infrastructure to the semiconductors and the cleanish energy, right? Some of the tech isn't really clean. I mean, it's still natural gas related. Ultimately, there will be another crisis. They'll spend more. In order to offset the deflationary pressures over the next decade, they have to grow everything. And if we choose austerity, then we're going to plan for the mother of all crash and basically another financial crisis. Now, I understand why people voted for Trump the first time. I get it. And frankly, in hindsight, COVID was probably good for him because the recession that I think was coming in his last year, he didn't get tagged for. But if they really come in, and I'm not talking about Project 2025, that's something even worse, but the 47 points or whatever it is that are on Trump's website about basically stifling government spending. I know that people think in household terms, oh, well, if I can't overspend, then the government can't overspend. It really is a truly different animal. Micro and macro, much different. If we end up by executive action or whatever, going through an austerity phase, which is what I think Trump might do. I mean, it's what he says he's going to do. And I don't know that he really understands that the people around him are just doing whatever they want in some cases, because I don't think he has that close a handle on it. He didn't before. Why would he this time? If we really do austerity, which is the threat of the Trump campaign, it's a whole different investment mindset. We'll have to flip. And we'll ride the rally up in the short term, and then we will sell to the suckers. And I want you to understand something that I have come to understand. I'm not sure why it is. That's above my pay grade. But when the bad things happen, people always rationalize that they didn't have anything to do with it. Somebody else's fault. We always blame. When I say we, I mean, 80% of people blame. That 80-20 rule is just so in effect almost everywhere. When the real bad things happen, maybe 20% of the people who voted for it will figure it out that, ooh, I made a mistake. May not ever say it, but maybe they'll vote different the next. I don't think certain things will change even if Trump wins, because there are a lot of entrenched interests out there, right? I don't think he's going to get rid of clean energy policy because you'd have to just dismantle everything, which you can't really do without Congress. And frankly, the oil and gas industry wants what was in the Inflation Reduction Act. They want it. It's a couple years in either direction for them don't matter so much. They want that stuff long term. They want lithium. Exxon's getting into lithium. They want carbon capture. They want to get paid to fix the problem they helped create, even though, and remember, we had to have fossil fuels the last 100 years. Without it, the economy would have never grown, right? We're just at a point where we have to change. And we can blame them for ruining, the climate, but the reality is it was all of us. You can't just say, oh, Exxon, you did this. You drove your car too, man. So I think it actually makes sense to enlist the oil and gas companies to help fix a problem that they were part of creating, but really we all did, right? Oh, you produced oil. Yeah, but you drove a car. So I think it makes sense the oil and gas industry to be involved in cleaning things up. And they're going to need something from society to do that because it's really expensive. And that's the IRA. The flip side is they're going to get sued. Exxon and Chevron are going to continue to get sued. If you're ever on one of those juries, ask yourself the question, did I stop driving a car, right? Did I stop heating and cooling my house, right? Did I go 100% solar when it was real expensive? So I think that there's rational, less emotional ways, more logical ways to deal with all of this. I think we'll do it. I'm not positive. In fact, I am pretty positive. I just don't know the timeline. Does it take us 5 more years to figure this out, or do we get it figured out sooner? I don't know. We're going to find out a lot in November. If President Trump wins and they really are adamant about pushing an austerity program, it'll hit pretty quick. It will take a year, maybe, on the outside, as capital just falls off. You're already seeing big selling by insiders on certain companies. Zuckerberg, Bezos. Why are they doing that? If those are really forever investments, why are they doing that? The actual answer is a little bit more complicated than they just think it's high. It's because they're entrepreneurs at heart, even if maybe they have some psychopathic tendencies, like a lot of those folks do. But they see opportunities in smaller things that will grow to be big. Peter Lynch, right? Small companies that grow to be big companies are where you make the most money. You think a rich guy like Bezos or Zuckerberg is suddenly like, oh, I'm just going to be happy with what I did in the past. I'm not going to try to get into the next big thing. Come on. That's exactly what they're doing. NVIDIA just bought a company or invested in a company that helps other companies use AI. What have I been talking about for months and months? The big opportunity that's coming is in those industrials and even financials, I suppose, and healthcare, right? We've talked about pharmaceuticals. The impact of AI on operating companies to expand their margins. And as AI gets cheaper, remember, the margin at the tech company will drift down, not much, but it'll drift down. It'll stop going up, while the margins at the industrials, the healthcare companies, the pharmas, the financials go up. So the shift that's occurring, I think, is going to be pretty sustainable. Now, I know some of you are with me on the small cap investing. We had a really good week. I think we're going to have more. At some point, technical analysis fails because pictures are open to interpretation. Ever go to an art gallery? 2 people looking at the same picture tells them different things. What doesn't lie is math. And the quantitative factors that underlie the charts are really what give you the better definition of the picture. Ultimately, value is value. We know what the range is historically on price to free cash flow between 6 and 12. When price to free cash flow is close to 6, you pretty much want to buy it almost every time if you believe the company will continue to grow. And when it's close to 12, that's usually when the early money exits. They take their leveraged double, which is usually a quadruple, right? Because they leverage at 2 to 1 in most cases if you're private equity, and then they exit. We don't take leverage, but we can still double our money every several years by just understanding the ranges on free cash flow and price and things like that. When I was at the oil and gas conference, I talked to you about that. Private equity firms like to buy at about 6 times free cash flow, that they lever up at 2, sometimes, the aggressive firms at 3, 4, 5 to 1, but in general, 2 to 1 is normal. And then when the price gets to 12 times free cash flow, they sell it to a big guy, right? Somebody who needs it for their operations, right? They're looking for scale. If you can make a pretty good free cash flow estimate of something over the next 3 to 5 years, which is what Value Line does and a lot of other analysts do, which is why I use those ranges that they create. And then I try to decide, okay, is it more likely to be closer to the low end or high end of the range? Or is the range just not right? Are they missing a fall off the cliff, or are they missing something that could take it to the moon? Take a look at a company like AST Space Mobile, which I really pounded the table on hard last year. Remember, Watson, I'm calling you from space was an article that I wrote. Its stocks tripled. Spire Global, since I interviewed the CEO, is up over 100%. AMTX has been all over the board, but since it got on the Russell 2000, it's up 20%. 2 weeks. Because quantitatively, 4 to 5 million shares are soaked up by Russell 2000 funds. It's become a more expensive stock to short because there aren't a lot of shares out there to short anymore, and they've been covering. If retail had any idea really how to invest, they would just be loading up on all of these stocks that just got on the Russell 2000, but they won't. Not until they see IWM outperform for a quarter or two, and by then the big opportunity is gone. A lot of stuff has already gone up 50 or 100%. If you're sitting on cash right now and you are a put seller, you should be doing, and I'm going to have a big list on Monday, you should have a big range of puts that you're selling over the next 2, 3, and 4 month durations. You should pretty much use up most of your dry powder in the next couple of weeks, I think. By the end of July, I guess. Maybe by the end of August. Because whatever jitterbugging happens during these conventions is just going to be met with a sigh of relief when we finally get whatever news we're going to get in November. And then what happens a year after that, as we go into the potential end of a bunch of the Trump tax cuts, right? There might be a bunch of sellers at the end of 2025. We'll see. Ultimately, I think the S&P 500 gets to 10,000. I don't know, by 2028. But I think the Russell does better by a little bit. But I think the biggest winners will be the individually picked small cap stocks, right? Because we know that most small cap stocks in Russell 2000 are not profitable. Only 700-800 of them are profitable at a given time. That's why you don't buy that index. I mean, you want to trade it with options, go ahead if you think you're a superstar. But really just pick out a dozen small caps and know what you're doing, right? Understand what you're truly investing in, and don't be so speculative, right? The reason I don't do a lot of biotechs, but I have found a couple that are interesting to me. The reason I don't do a lot of biotechs is because it's just so hard to figure out who's going to be successful. Small cap biotechs, I'd rather buy a fund. Just buy the fund when it's historically in a trough. All right. Any questions before I decide to jump in the pool on this 90-degree day in Milwaukee? Mr. Pineapple says, I have the index in my 401k. What do you mean, IWM? Yeah, it's not a great choice, but that's what you got. Really, no questions? I talked about a lot of stuff today. Do you understand that the government needs asset prices to go up to generate taxation to pay their bills? And they're going to need the banks to buy treasuries. They're going to need lower interest rates. Without those things, we have a deep recession and then massive spending in QE after it. So whichever way things turn out, it does kind of work out the same 5, 6, 7 years out. It's just, do we get choppiness and up, or do we get a spike and a crash and a spike? I don't know. Somebody asked, what could cause the market to correct 5 to 10%? What am I going to say, folks? What is my answer? What could do it? What could cause a 5 to 10% correction? It's the aliens. It is. It's the aliens. It could be anything. Who cares? Who cares? Who knows? Who cares? What difference does it make? Why ask? Remember the Bud Dry commercials? Why ask why? It doesn't matter. It just doesn't matter. Predict less in the short term. Understand the long term. In whichever way the line wiggles, use it to your advantage. Stop thinking about what could happen next week. Who cares? If the stock market takes a 5 to 10% correction because Trump says something dumb at the Republican convention, whatever, who cares? You buy it. You buy small caps. You buy companies that have monopoly pricing pressure, power, right? So one of the things I'm shrinking down the grandpa list. I am mostly done with the dividend list and the grandpa list. The grandpa list has 5 forever stocks. In my opinion, there are only 5 forever stocks in the United States stock market, meaning that stocks that you always buy in the dip and then you almost never sell. Stocks that I think that in 10 to 20 years will still be good company. What are the 5 stocks? And why did I pick them? I bet you can guess all 5 pretty quick. Name 5 forever stocks. It's only 5. The whole stock market, 5 forever stocks. What are the 5 forever stocks? What's the strongest financial company in the world? Berkshire Hathaway. That's 1. What stocks would my ma like? Microsoft, Apple, Alphabet, Amazon. Not Walmart. Google, Apple, Amazon. The ma stocks. Remember the ma stocks? Microsoft, Alphabet, Amazon, Apple, and then Berkshire. Those are the only 5 forever stocks from what I can tell. Walmart is cyclical. You trade it, you can position trade it forever. I think the giant rally they had and the Costco had I think those were just giant rallies. I think they'll both drop 30 to 50% at some point. I think the Target and Shopify deal is going to be monumentally huge. But why Apple, right? Fortress balance sheet, and half the people on the planet have their product. Well, in the developed market, billion six, billion seven. I forget how many iPhones are out there now. Clearly, the number one consumer franchise in the world, and there's big recurring revenues attached to it. And then what do Amazon, Google, and Microsoft all have in common? Really three things: the cloud, AI, and then there are other tech businesses, whatever they are specific to that company. Microsoft, for whatever reason, people can't get away from Office. All of Google's tools, all of Amazon's tools. Ultimately, Amazon, I think, changes because I think that AWS gets spun off. Then that becomes the must-own, and Amazon, the retail side, I'm not sure about. Interestingly, and I don't think the damage will be big soon, but Amazon as a retailer, I think, is peaking. I asked that a couple of years ago if they were peaking, and then COVID happened. I think Amazon's pretty much peaking in the United States anyway. Maybe they grow internationally. Jumia, by the way, have you been watching Jumia? If you had put it in a drawer and done nothing the last 2 years, you would have had all your money back and been profitable, right? The wiggles in the line. The stock that we picked out at $7 a share went down to 3, and now it's back up over 10, right? Talk about a lot of things, folks, and they turn out to be pretty interesting to watch over time, and they have turned out to be mostly right. All right, so what I am going to do is I'm going to play this Luke Grumman interview. I can't give you the link because there's a password involved, but I will let you watch this. All right, everybody, have a great weekend, and remember, enjoy the summer. There's not really a lot of trading to do. You just do your weekly thing, and you should be in good shape. If you are a swing trader, Shooter apparently got power back, so you can go back to talking to him. All right. Have a good weekend.